I want to welcome everyone to our next workshop. Today's all about, or this month is all about estate planning. Now, it says estate planning 101. I have to tell you, it does get a little bit more complex as we go. Some of this may be very, very important to you. Some of this may not be. It all depends where you are and how you want your estate plan set up. All righty. So for those of you who don't know, I'm Chris Price. I'm one of our certified financial planners here on staff. For those of you who have been to these workshops that we put on every single month, I want to welcome you back. For those of you that are new, every month we're going to put on, or I'm going to put on another workshop about different financial topics. As you've already guessed, today's about estate planning. So what are we going to talk about? First, we're going to talk a little bit about what is estate planning. We're going to talk about some of the tools that we're going to use for estate planning. We're going to talk about some of the estate tax that some people might be concerned with. We're going to talk about some estate planning strategies. We're also going to talk about some gift strategies. I, again, want to make sure that everyone knows that some of this is going to be super important that you're aware of and that you do, and some of this is going to be a little less. But again, we'll start with estate planning and get more and more in depth. So let's talk about some of the tools while we talk about what estate planning is. So estate planning really is the planning we need to do for where our assets will go at passing. So let's kind of talk about that. Most people are familiar with a will, and we'll talk in more in depth about a will later. But a will is basically that last letter you'll write about where you want your assets to go, who you want them to go to. If you don't have a will, you will go through the probate process and you'll do something called intestate, which is that other word you'll see there. We're going to talk more about that. And as everyone knows, one of the best things to do with estate planning is make sure you have your right beneficiaries. And we'll talk a little about trust later. So let's talk a little bit about wills. So the purpose of the will is to ensure that your assets go to the dependents that you want. So think of a will to help you appoint a guardianship to minor kids. They appoint an executor or personal representative to oversee how your assets are distributed, right? The accomplishment of this is to basically put your wishes on paper because as you might have already realized, this time in your life, you won't be there to make decisions on yourself. The key things I want everyone to know about this is that last line item. This is a public document. So this is read in probate. This is able to publicly research. So mind you, this letter is something that everybody will see or could see. Now, if you didn't have a will, you die intestate. And basically what that means is you're going to follow the rules of that state. Now, each state is different. I'm here in Florida, and the rules that we're going to have are going to be a little bit different than other states that you might be in. So just be cautious of that when it's coming to your estate plan. Sorry about that. Got a little warning. So like for instance, if we look at our screen right here, we can see that we have a husband who passed away. Half the money went to the wife. The other half was split between the kids. Now, this doesn't mean this is the way it works always. Your state makes that decision. The point I want to make clear about this is if we don't have a will, if we don't have trust, if we don't have these documents, the state is already going to determine where and how that money gets distributed. You can imagine this causes some problems when you die this way, right? It may cause disputes amongst family members. They thought they were getting this or thought they were getting that or whatever the case might be. If there's multiple marriages or blended families, causes obviously another complexity to a simplistic setup the state is set up. Talk about beneficiary designations. Now, most everybody on this call, I'm assuming, is aware of beneficiary designations. They are extremely important. And what we see on our screen is actually the four most common places we have beneficiary designations. But I want to be clear, you could have beneficiary designations on more things than just those four. But for those of you on the call who have annuities, life insurance, retirement accounts, individual IRAs, you would have had to assign a beneficiary. Now, that beneficiary, as the first line says, passes outside of probate. So it doesn't matter about the court proceedings. That money goes to that beneficiary even before that court proceedings happens. Now, there's a unique thing that Florida has, which we're not going to get into, but generally speaking, this is how it works. So, for instance, all you would need is a death certificate and you being the named beneficiaries, and that money can pass to you or to whoever that beneficiary is. Question I ask everybody is that second line right there. When was the last time you reviewed or updated your beneficiary designation? Has something changed in your life since the last time you did that? Was there divorces, deaths? Make sure you keep them up to date. Because like I said, it's not going to be in that probate process. It's automatically going to pass right away to them. Make sure it's where we want it to be. Another thing we're going to talk about is trust. There's really two main types of trust. One's a revocable trust, and we're going to talk about irrevocable trust next. But a revocable trust is going to be your most common trust. And when you hear someone say trust, 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 there's a very, very high likelihood they're talking about a revocable trust. The value a revocable trust has is it could be changed or amended. Right? So basically, you can make changes to it. You could get rid of it. You could replace it. You could keep making changes to it if you're the one who sets it up. Another key factor, it avoids probate, but assets are still included in estate tax, just FYI, which is a later conversation. So even though this will avoid probate, if we're calculating taxes, the revocable trust still counts towards that. Third one, which is probably one of the biggest reasons why people will do a revocable trust, is ensures privacy. A trust is not a public document. So I mentioned earlier with that will, a will is read in the court system and is a public document. A trust is basically like a safety deposit box. And what's in that safety deposit box is not going to be public information if done correctly. Right. Fourth, trustee provides asset management during incapacity or death. Basically, if you couldn't take care of this yourself, then your trust may be able to assign someone who can. Avoids delay. Now, what do we mean by avoids delay? Really, avoids delay is really indication of that probate process. If any of you out there have been part of a probate process, or at least have heard about a probate process, it could be months or longer before things are worked out. This will delay that. Avoids will contestant. Basically, a will, because it's a public document, anyone can contest that will. Well, trust will not let that set up. Irrevocable trust, the second kind of trust. This is a lot less common, but made for certain reasons. A lot of times it's made for tax reasons, but an irrevocable trust. The main disadvantage to an irrevocable trust is it cannot be modified, amended, or changed. That is the main disadvantage. Once it's set up, once assets are put in that trust, it has to follow exactly what that trust says. No ifs, ands, buts about it. Right? It can, though, manage assets for minor beneficiaries. So maybe you have beneficiaries that are under 18. Maybe this is more of an advantage way. Right? It can protect assets from unrelatable beneficiaries, creditors, things of that nature. There's more protection in an irrevocable trust than a revocable trust. Can provide for multiple beneficiaries, can have professional money management. It ensures the estate plan is complete. And this isn't one of the main reasons I was saying earlier of why someone's going to do an irrevocable trust is it provides maybe an estate tax benefit for those in that consideration. And we're going to touch on that a little bit more. So for those of you who don't know, there are many ways we get taxed in this country. We may get taxed also when we pass. An irrevocable trust has those tax benefits of trying to help with that scenario. How it does that is it excludes those assets from your gross estate. So we're going to talk a little bit about what a gross estate is. And the job of an irrevocable trust is to exclude it from that gross estate. Cool. Main disadvantages, as I spoke about before, loss of control. Right? You can't make any changes once that's set up. Cost of creation. Now, irrevocable trusts are definitely more expensive than revocable trusts. Third one, irrevocable, which I think I just mentioned that. And then fourth one, which is just a greater detail of what irrevocable means, limited access to whatever was in there. So now let's talk about that wonderful thing called taxes. So there's 5 different ways that we're taxed when we pass. There's what they call income tax that we're familiar with. There's estate tax, there's gift tax, there's generation skipping tax, and there might be, depending on the state you're in, state taxes for that. So there's quite a different amount of bureaucracy that comes out and tries to take that money from you. So let's first start talking about the federal estate tax. So this federal estate tax was a lot more concerning years ago than it is now. And that main reason is because there's an exemption. If we look at that second line, it says federal estate tax exemption, $13.6 million. So basically anything under that won't be taxed for estate tax purposes. The third line is something everybody on this call should pay attention to. That third line says most assets receive a step up in basis to the fair market value of the asset upon date of death or alternative minimum date. So what does that mean? That applies to everybody on this call. It doesn't matter if you had the $13+ million or less. This is something important that we go over. Basically what this step up in basis means that if you were to, or somebody who you know was to own an asset and they paid a certain dollar amount for, maybe they bought something and they paid $100,000 for it, and then years go by and they pass away, and that thing that they paid $100,000 for is now worth, let's say, $500,000. Well, at passing, when that next person receives it, their step up, their cost basis is going to be $500,000. That doesn't mean they cost, that means their cost basis. And the reason that's valuable is if that person goes to sell it, they only have to pay tax on profits above 500. So I'll give you a little example of what I mean using the same numbers. If you were to buy something that cost 100 grand, X years goes by, you sell it for 500,000, you have to pay tax on that $400,000 in profit you made. Now, if you bought something for 100 grand, you end up passing away and that property is worth $500,000. Your beneficiaries, your kids, end up selling it for 550,000. They're only going to pay tax on that 50,000. So we can see how that's huge, how that gift actually increased that cost basis, so it lowered the amount of taxes they're going to have to pay. And just for that last line, Form 706 is the federal estate tax form that has to be filled out. State death tax. Now, we're not going to get into too much detail about this. I'm going to be quick over this because it really depends on the state you're in. Different states have different state death tax. So just look at your state and see if this is a concern that you may have. Cool. So, state tax fundamentals. So we're going to talk about the actual tax rate throughout the year so we could see what we talked about. We're going to talk about the gross estate. I spoke about that a little earlier and what that gross estate means. I spoke about that when we talked about the difference between revocable trust and irrevocable trust. A revocable trust, those assets are still in your gross estate and marital deduction. So let's say you're one of those individuals who has an amount of assets that's above that threshold. I showed you that threshold of $13.6 million. If you are in that scenario, every dollar that transfers to your beneficiaries over that will be a 40% tax. So for every dollar above that 13.6 million would be 40 cents sent to the government. There are ways to help that. Now we may be thinking, okay, we're not even close to that 13. Well, what actually is considered when we try to get to that $13 million? Well, that's really where they talk about your gross estate. And literally, your gross estate includes everything that you could possibly think of that you have some kind of control over. You may not even own it outright, but you have some kind of control over. So, some of the obvious things are like retirement accounts, annuities, deferred comp, properties. Some of the less common is like maybe you have life insurance on yourself that's going to be given to someone else. That's part of your gross estate, if not structured properly. Or what if you have vehicles or properties or jewelry or anything and everything that you have is included in this gross estate? Now, if you are married, though, you could transfer the unlimited amount of money to your spouse if you're to pass without this concern of estate tax. So I don't care if you have $100 billion, it can move to your spouse and you don't have to worry about that 13.6 or $13.6 million. Now, when they pass, might be a concern, but you're not going to have to worry about that. So now let's talk about some strategies, some estate planning strategies. The first one is just having a simple will. Think of this as I love you will. This is just saying to my beneficiaries or my beneficiary, this is what I want because of this. This is how I feel. You need to name an executor or a personal representative, depending which state calls them something different. Right? And you have to obviously list who's getting what. Now, if you are in one of those scenarios that you are above that $13.6 million and you are married, you may decide to do a credit sheltered trust. Now, a credit sheltered trust actually allows you to put that $13,600,000 into a trust, and everything above that goes to your spouse. So you're not taxed on any of it. And that $13.6 million can go to the family at the passing of your spouse. So for instance, if you're somebody with, let's say, $20 million, right? Well, and you want to make sure some goes more than just to your spouse, you could have 13.6 million go to this tax shelter trust. Your spouse could still, the 7 go to them. And if they ever needed the 13 million, they still could, but it's in that trust protected for when they pass. Now, if you don't do that, you still have what they call portability. Portability means you still get that $13.6 million, even if you didn't give it, if you gave it all to your spouse. I'll make an example. That person that has $20 million, if one spouse passed and it all went to the other spouse, they didn't pay any taxes, right? Because it all went to the other spouse. And then if that spouse passed, they would have the 13.6 times 2, because there's 2 people. So $26 million, that 20 would pass and you wouldn't be concerned with paying that state tax. So if you don't do a credit shelter trust, you could always use portability. But now if they have this portability, why use the credit shelter trust? The real reason is to basically stop the appreciation of that $13 million. So if I was to pass and I had $20 million in the example, I could give this to my spouse, or I could put 13.6 million into a credit shelter trust. She could still use that money, but as that 13 million grows, they're still only going to consider that 13. Maybe she outlives me by 10, 15, 20 years. But that 13 should have grown so much. That's not a concern if we've already put that in that credit shelter trust. So the main reason you would use credit shelter trust over portability is to stop the tax growth of those investments, basically, or those assets. So another strategy we have is gifting. Now, a lot of people give a certain amount of dollars to their beneficiaries while they're in there, while they're living. And a lot of attorneys recommend doing this. But mind you, there's still a concern when it comes to gifting to beneficiaries. So we could talk about why gifting during your lifetime. We could talk about gift strategies, and we could talk about using life insurance in this. because that's really where it's most popular. So what makes gifts during your lifetime, or why make gifts during your lifetime? Woo. So the point of making gifts during your lifetime is to lower the taxes of that estate tax we talked about. So if you could keep giving assets throughout your lifetime, you might not have to worry about the estate tax. The value is the dollar amount you transfer for is the dollar amount they get, as you can imagine. For 2024, the gift tax exemption is $18,000, meaning if you were to give more than that, you might owe some taxes. You can do what they call gift splitting. That means a married couple can give one person the double amount. So 18 plus 18, $36,000. Disadvantage of gifting. The disadvantage is once you gift it, you have no control over it. If you retain any control of it, it's not considered a completed gift. So one of the big questions everyone asks is, okay, well, if I am above that level, that 13.6 million, what if it's in a big property or something I can't just liquidate right away? How do I pay that 40% I need to? And that's really what we're talking about here. We could obviously sell those assets, right? We need to understand the difference between liquid assets and non-liquid assets. So liquid assets are ones we can give right away. Non-liquid are ones we can't. So can we turn non-liquid into liquid? You can talk about borrowing the money, loans and things of that nature. And obviously, like I said, that's where life insurance really gets used because it's cash right away. What most individuals do is they'll set up an irrevocable trust for life insurance. If you remember me talking about earlier, so life insurance is still considered in the gross estate, but irrevocable trusts are not. So what you want to do is you want that insurance in your irrevocable trusts. Now, this could provide asset management, fiduciary responsibilities, accounting and paperwork. It could be credited protected, spendthrift, these good things. Most of you might have heard this term. It's called an ILIT. So an ILIT is exactly that, irrevocable life insurance trust. And it's designed to complete this exactly. How it actually works is you gift the trust and the trust pays the insurance. So you don't own the trust, you don't own the life insurance, the trust owns the life insurance. All righty. I hope everyone had an amazing time. I know that was a lot of information, especially once you get to a certain dollar amount of asset that's going to pass. If you do have any questions, our focus isn't just to shove that information out there, but also educate, help, and work with you on having the best plan for you. So we talked about an estate plan. We talked about tools to transfer. We talked about the tax. We talked about strategies. We talked about gifts. Hope everyone has an amazing weekend, and I look forward to seeing you next month.